Hello and welcome to CFO Insights by Hyperbots. Welcome to today's discussion on the variability of the chart of accounts, or COA, across different industries, companies, and ERP systems. Joining us is Anthony Peltier, the CEO at Coast to Coast Finance, who will share insights on how the COA can differ based on several factors. Welcome, Anthony.
Thank you. Glad to be here.
All right, so let's just dive straight in, right? Can you start by explaining what a chart of accounts is and why it's essential for organizations?
Yeah, chart of accounts or COA, basically a list that categorizes all the financial accounts in the general ledger. And it really serves as a framework, right, for recording and reporting the financial transactions. So the COA is essential. It really provides the structure needed for consistent reporting, compliance, and analysis. And then it helps ensure that all the financial data is captured accurately and can be reported in a way that really aligns with both the internal and the external requirements.
That makes sense. So, how does the structure of the COA vary between different industries?
Yeah, it varies pretty significantly between industries because each industry has unique reporting needs. For example, a manufacturing company could have raw materials, work in progress, or WIP, or finished goods under their cost of goods sold or COGS, while a service company, such as a consulting firm, would have accounts that more focus on labor costs, direct service costs, or even a retail company may emphasize more inventory accounts, sales revenue, and a financial services company could have specialized accounts for like interest income, loan loss provisions, and even brokerage fees, stuff like that.
Okay. So, we talked about how COA might vary between different industries, but what are some specific examples of how two companies within the same industry might have different COAs altogether?
Sure. I mean, even in the same industry, companies can have different chart of accounts based on their business models or operating costs. In the technology industry, a more product-focused company might have detailed accounts for hardware production, software development, cloud infrastructure, whereas a service-oriented tech company might focus more on like support costs, software as a service operations, and professional services. Even like two retail companies may differ. One with a brick and mortar could have detailed accounts for store rent, overhead, while e-commerce would probably emphasize more digital marketing and logistics costs.
Okay, so what factors typically drive these differences in the COA structure from one company to another within the same industry?
Yeah, several factors, right? Company size, business model, geographic location, regulatory environment, maybe even strategic goals. For instance, a global company is probably going to have a more complex chart of accounts to manage varying currencies, tax jurisdictions, intercompany transactions, whereas a smaller company might have a simpler chart of accounts, but still reflecting its focus, like a startup emphasizing R&D costs, their risk appetite, management style, and all of these things kind of play together that would influence the chart of accounts structure.
So we talked about a lot of big companies, right? So could the same company have different chart of accounts for different ERP systems? And if so, why would that be the case?
They could, yeah, for different ERP systems, maybe because specific functionalities and reporting capabilities of each ERP. So one ERP might be designed to meet local statutory requirements. Maybe it necessitates a more granular chart of accounts for tax reporting or currency differences. Another ERP, like at a global level, probably use more standardization and consolidation across geographies, and this can lead to a different COA structure. The differences in the ERP configuration and how the systems really integrate with other financial tools could also kind of contribute to some variations there.
So what challenges do these differences in the chart of accounts pose for financial reporting and management?
Yeah, that's a good question. I say the main challenge is maintaining consistency in financial reporting. If a company has different chart of accounts across business units, then consolidating those statements becomes complex and time consuming. There's risk of error there that can affect the accuracy of the financial reporting. Additionally, different chart of accounts can really complicate internal management processes. which would make it harder to compare performance across divisions or subsidiaries and really ensure compliance with accounting standards.
Okay, so how can companies manage these challenges and ensure effective financial management?
Well, you should really aim for a balance between standardization and flexibility. Having a master chart of accounts that can be mapped to different local or business specific charts that can achieve consistency while allowing for some customization. Obviously, you want to do regular audits and reconciliations to ensure alignment. Then you can leverage technology like consolidation tools and implementing governance policies. Then, of course, you want to be training and communicating continuously between the finance teams across the different units. That way you can really maintain clarity, coherence.
That makes a lot of sense. So, finally, what trends do you see in how companies are approaching chart of accounts design and management in the future?
I do see a trend towards increased standardization and automation. So the amount of time that some companies spend thinking about and developing their chart of accounts can be significant. So they really want ways to simplify, streamline the COAs that enables faster decision making. There is a move towards a more global standard, especially for multinational companies. This will reduce complexity, improve comparability. Now, AI is huge, right? So, especially AI in finance, you can use AI machine learning tools to help companies kind of automatically categorize transactions and then even suggest the optimal COA structure. So I think that shift will continue as companies really seek greater efficiency and agility in their financial operations.
All right, I think that is very, very insightful. Thank you so much, Anthony, for sharing these valuable insights on the variability in the chart of accounts and its impact on financial management. It's pretty clear that the chart of accounts is more than just a list of accounts, right? It's a strategic tool that needs careful design and management.
Yeah, thanks for having me. It's definitely an important topic.
Thank you so much.